Okay, so let's start. Hi, everyone. For those who just joined us, I'm Charles. Welcome to this first webinar about PGE. I will be your host with Jorn. Hi, Jorn.
Hello, everyone.
So this webinar for lenders is about the French state-guaranteed loans. Today, we will explain in detail why these loans were created and how they work, and we'll answer questions you may have on these topics. So how is it going to work? We will address 3 different topics. You can ask questions at any point of the presentations on the right side of your screen, and we'll answer at the end of the webinar. And also, you will be able to rewatch the webinar for a link that we're going to send you by mail at the end of the presentation. So as I said, I'm Charles. I'm a customer success manager since 2 years now at October. I'm dealing with French lenders. And Jorn, I'll let you introduce yourself.
Yes, hello, everyone. I'm Jorn. I'm also working here for 2 years now, and I'm the customer success manager in the Netherlands, and also for the international people.
So, as mentioned at the beginning, this webinar is going to be divided in 3 main topics to get a complete overview of how the French State Guaranteed Loans works. First, we will explain what's French State Guaranteed Loan and what are its objectives. Secondly, we'll continue with the most technical parts, so that's what will be interesting you, presenting the specificities of these loans in terms of duration and interest rates. And lastly, we'll show you how to easily spot those projects on the October app. So let's get to it. As you all know, the COVID-19 situation created an economic uncertainty. Since the crisis started, October has been taking some actions to help companies cope with the COVID-19 outbreak. In last March, we asked lenders to vote about an automatic 3-month capital freeze repayment for all the borrowers. With this initiative, our lenders ensured their profitability and the support to SMEs through this exceptional situation. And since last April, October is going further by financing companies that need cash flow through state-guaranteed loans. In particular, in France, the government announced a 300 billion euro package in state-guaranteed loans to ensure liquidity for French SMEs. Now, more than ever, as you know, those SMEs that need credit to continue with their activity and keep growing, and it's a key for governments to avoid a credit crunch among lenders. With this guarantee, the French state covers up to 90% of the capital lent and make the investments safer for you. Before going really into details, let's share some data. Since we started distributing French state guaranteed loans on the platform, 36 French state guaranteed projects were financed for a total amount of 7 million euros for an average loan of 185k euros. On the lender side, a total of 6.5 thousand lenders, which represents approximately 28% of our active lenders base, have invested in these projects with an average amount of 46 euros. So let's get to it with the first subject. What is a French state guaranteed loan and what are its objectives? As I've said previously, the high level of economic uncertainty created by the COVID-19 and the measures taken to reduce the spread, especially the global lockdown that we all lived in, have hit SMEs in various ways. So think of restaurants, bars, hotels, and stores that were forced to close, or manufacturers that had to reduce production to match a decrease in demand. As a result of this, companies have seen their income temporarily dropping and are in need for additional cash to face their financial obligation during this crisis. In France, SMEs that request a state-guaranteed loan do it most of the time because they need to keep covering their fixed costs like suppliers, salaries, or taxes. But also, in some cases, SMEs need credit for new investments in order to seize new market opportunities. There is no particular eligibility criteria. Loans are for companies of all sizes and legal forms, but there are some exclusions. Firstly, companies that are subject to collective proceedings, so like safeguard proceedings, receiverships, liquidation, or personal reorganization, before the 1st of January 2020, or real estate non-trading companies, credit institutions, and finance companies. But how exactly does French state guarantee reduce the risk for you as a lender? So if you lend money to a project guaranteed by the French states, 90% of your outstanding capital will be covered in case the loan goes into default during all the period of the loan, and it's totally free for you. Even though the French state guarantee covers your capital in case of default, it doesn't secure the continuance of a business you lend to. And there is one unique situation when this can have an impact on the guarantee. If the borrower goes into bankrupt within the first 2 months after granting the loan, then the guarantee will not apply. And also, it's highly unlikely, but the guarantee doesn't prevent the bankruptcy of the French state. So if the French state goes into default, as I said, as you may guess, it's highly unlikely, but it could happen. Then you may lose your capital. So in one word, the guarantee of the French state makes it safer for you as a lender to lend to an SME. And I'll now give the floor to Jan on the second part.
Yes, thank you, Charles. Now, what makes these French state guaranteed loans really unique are its conditions. In the second part of the webinar, we will see how the conditions of a state guaranteed loan can evolve and how this impacts the duration and the interest rate. So first, how does it work? Well, initially, all French state guaranteed loans are bullet loans with a duration of 12 months. That means that the borrower makes one capital repayment and one interest payment at the end of the 12-month period. However, and this is what makes the French state guaranteed loan so unique, the borrower can extend the duration of the loan after the first 12 months and spread the repayment of the loan over 1 to 5 additional years. It is the borrower who decides this. So that means that after 12 months, 3 things can happen. In the first case, the borrower repays the full loan. In that case, you will receive all your capital plus 2% interest on your October account at the end of the 12 months. In the second case, the borrower does not repay any capital. Then the borrower only pays the interest in the 12 months, and the rest and the capital will be repaid over a period of 1 to 5 years. This will be through monthly annuity payments, which is the payment schedule that we also use for our standard projects. The good thing is, though, that even if the duration of the loan is extended, the 90% state guarantee will still apply. And that means there's one option left. In this last case, the borrower only repays part of the capital. The rest of the capital will be repaid in a period of 1 to 5 years again. And this will also be through monthly annuity payments. Also here, the 90% state guarantee will still apply. When the duration of the loan is extended, we will notify you about the new duration and interest rate in an email that we'll send you. So in this table, you can see how the interest rate changes if the loan is extended. You can see that the rate depends on the credit score. Logically, an A+ project has a lower interest rate than a C project, although most of these projects are B or C rated. At the moment, we can say which borrowers will repay their loan after 12 months. Repaying the entire loan is the cheapest option for most borrowers because the interest rate doesn't increase and the borrower will be relieved of their debts. However, we don't expect a lot of borrowers will be able to repay the loan after 12 months. To repay the loan, a company should have enough margin, or in other words, a company should have more income than costs. Many companies that request this type of loans are experiencing reduced activity due to the coronavirus crisis. Therefore, we think that the probability of a company generating enough margin to repay the loan in 12 months is low. By extending the loan, the repayment is spread out, which reduces the burden on our company's margin. If you want to get some insight in the possibility of a loan not being repaid after 12 months, you could have a look at the company's net debt over EBITDA ratio. This ratio gives an indication of how many years it takes for a company to repay their debts based on their EBITDA margin. So I can imagine this is quite a lot to take in. I don't know if you have any questions about these conditions of the French state-guaranteed loans. You can ask your questions on the right side of your screen. So far, no questions, right, Charles?
I don't see any for now. You can keep going, I think.
All right, so let's keep going.
You're pretty clear.
That's good. All right, so in this last part of the webinar, we can have a look at the presentation of the French state-guaranteed loans on the platform. We have recently improved the design of our platform to make it easier to spot state-guaranteed loans. We've added a label to the projects with a state guarantee so that you can easily distinguish them from the projects that don't have a state guarantee. You can see this label, you can see it on in the leftmost screenshot. It's pretty clear. And next to that, we've highlighted the characteristics of the French state guaranteed loan. You can now click on the icon next to the interest rate if you want to be reminded of the conditions of the loan. And within the project description, we have also added a purple box with the specifics of these loans, as well as a link to the tutorial. And you can see this in the second screenshot from the left. All right, going on to the project presentation. Maybe you've noticed that most of our French state-guaranteed projects are instant projects. If a company borrows less than 250,000 euro and can be covered by the French state guarantee, the project is analyzed by Magpie, which is our automatic scoring model for financing requests. Magpie was built using machine learning algorithms and is based on huge amounts of data. What Magpie does is it analyzes the probability of default for a company and analyzes this on a scale from 1 to 5. And from this scale, then a credit score will be assigned to the project, and it will be decided whether we're going to do the project at all, actually. If the project is analyzed by Magpie, there will be some differences in the project description compared to our standard projects. The project description of the instant projects is standardized and contains less information. For example, there's no analyst opinion, because this is normally written by our financial analysts, which are not involved in these kind of projects. Instant projects always have a credit score of B or C, depending on their Magpie score. So with that, we have already reached the end of the webinar. We hope that you now have a clear idea of these French state guaranteed projects, and that you will feel more comfortable making an investment. If you have any questions, now is the right moment to ask them. Let's have a look.
I don't think there's any question for now, but if you don't have one right now, people, you can also always reach us through the chat or by email or even by phone. Let's hope that you don't have any question, because we are really clear. Yeah.
All right. Okay, we don't see any questions coming in, so I hope that's a good sign. Well, let's end the webinar here then, and we'll say our goodbyes, and I wish you a very great rest of your day.
Thank you very much for your presence.
Yes, thank you.